So thanks for joining me today on this podcast. So this one's going to be a fairly quick one. You've heard me talk a lot about the infinite banking concept. You may have heard it called bank on yourself, privatized banking, family banking, all kind of the same, all originated from R. Nelson Nash's book, Becoming Your Own Banker. And so if you haven't read that, I would highly encourage you to go read that book. It's a encapsulation of a 10-hour seminar that Nelson Nash used to do before he passed. And so it gives you at least a good starting point and gives you some of the fundamentals about the infinite banking concept. Today, I want to cover just something basic, the pros and cons to the infinite banking concept. There is no financial tool that I know of that is perfect for everybody in all situations. And we just have to understand what they can do for us and what they can't, and this is where I have to kind of preface this to say I'm a big fan, but I also know it's not for everybody. And so today I'm going to cover the 5 pros and cons. So let's start with the pros. I always like to start things more positive. And so one of the biggest pros that I see around the infinite banking concept are the tax advantages. Life insurance has been designed and the laws indicate that there's a lot of tax advantages by using a product if you use it wisely, right? Within life insurance and the types we use for the infinite banking concept are whole life policies. The the cash value that's built up over time grows tax deferred, technically. And if used wisely, it can be tax free all through life. And so the death benefit also is income tax free. And for most people who don't encounter large estate tax problems, it's also going to pass through estate taxes tax free. And so there's a lot of advantages to storing. And that's why back in the 80s, when laws changed around real estate investing and the tax rules around that, a lot of folks actually migrated to life insurance in a way to store cash tax efficiently and almost like a tax shelter. So there's a lot of great tools around it to use life insurance in a tax advantage way. And we'll go more into the other aspects of it that are also tax free, like loan provisions with it. But in essence, your money is growing tax deferred and can be sort of passed tax free, and you can actually use that income during retirement or later stages in life as a tax free source of income as well. Because the way that it works within life insurance is that you can withdraw your money out first, of what you've contributed, and then any of the gains that are tied within these policies can be accessed tax free through a loan provision that is within the contract. So we'll go into that a little bit more. So a lot of tax advantages from a use of the dollars throughout their life, as well as passing on to future generations. So the second pro that I see is that given the nature of how we design these sorts of policies, there are a number of guarantees tied to them. One being that the cash value is guaranteed to grow at a minimum level. Now, the dividends that also are potentially given to policy owners is not guaranteed, but they've been paying them for well over 100 plus years for the companies we use. So in essence, they are fairly expected. You're going to expect them, but that by contract are not guaranteed. Now the base premium for these types of policies are also guaranteed to never go up, so they're level, just like you would associate with a mortgage. So they're going to stay flat and guaranteed to never go up. And then the final guarantee I think is important is the death benefit. Now, for those who are using these types of policies more for infinite banking, I know death benefit may not be as big a priority. However, it's still good, especially as we get later in life. That death benefit becomes a little bit more tangible and important, especially around transferring wealth and helping support the next generations or even our direct spouse, right? That's going to help protect them. So all those guarantees that are built in this put the significant amount of risk to the life insurance company. A lot of the other policy types that you may have heard of, like universal life or index universal life, are actually increase the risk to the insured more than the company. So whole life puts a lot of that risk back onto the insurance company. Now, the third pro I see around the infant banking concept, and I guess these whole life policies in general, is the asset protection. So within a lot of states, the cash value in these policies are protected from creditors, lawsuits. So they're really shielded just like a qualified type plan, right? Those assets are secure from creditors. So this is a great spot if you're trying to store cash somewhere, right? If you compare this to a bank, that money is not completely protected and can be seized and garnished on a lawsuit. So for most states, and check with your local state to see how it applies, but most of them do cover and protect the life insurance policy cash value from any lawsuit that happens. So it's a great asset protection tool for those who are in the wealthy states, well, wealthy levels of wealth building, and can really provide some level of extra protection that just comes with the law, right? So it's really an important tool and certainly can be combined with trust work as well to protect a lot of those dollars even for future generations for asset protection. Now, the fourth benefit I see for the infinite banking concept and these types of policies is the access to cash value. Now, it's going to act a little differently. It's not like a bank account you're going to want to withdraw it, because one of the keys around the infinite banking concept is allowing your cash value to continue to grow and compound with the least amount of drag as possible from taxes, from fees and such. And so that can just grow and compound over long periods of time. And so, but you can access the cash value at least early on through a loan provision. You can borrow against it, use as collateral, and borrow directly from the life insurance company. And then you can control the terms of that deal. Now, it's not, there is an interest cost to it, but you can control when you pay it back. And it's built into the contract to be able to give us as insured members, to give us first right to use those dollars before they go invested. So it gives us access to it. Now, later in during the policy years, you may want to start withdrawing cash, which you can, and you could do up to your basis. So everything you've contributed first and all that is tax free. And then you can access the gain through a loan provision, and so that wouldn't create a taxable event. And so that's ways you can access the cash all through life and use it however you wish. There's no age restrictions. You get to use that and you pay that back when you want. And there are cases that down the road, if later in life, you may not pay that back. And so what will end up happening is the death benefit will actually pay any outstanding debt on the policy, and then the rest would go to the beneficiaries, heirs, tax free as well. So the last thing I would say in terms of a pro, certainly from my standpoint, is for legacy planning. For folks who have really adopted the infinite banking concept, this is more of a philosophy to help provide more stable capital storage and use of dollars, and then also use it for legacy planning to pass to future generations because of just the nature of whole life insurance policies. A lot of tax advantages, as we talked about earlier, but this can be provided to the next generation to also give them capital to build businesses, to invest, etc., and support them, the family and future generations. And if people are at levels of estate planning where they're going to might get a estate tax issue, you can also use these sorts of assets in irrevocable trusts that can be passed and bypass estate taxes. So there's a lot of really unique ways that this type of product can be used and for legacy planning, and in combination with other things like charitable donations and things of that nature with the sale of assets. So there's a lot of more sophisticated ways to do it, but it really can help ensure the smooth transfer of assets to the next generation. So really one of the maybe misunderstood sort of aspects around this sort of philosophy and sort of approach, but can have really powerful attributes as you're thinking about the next generations. So those are the five, what I would call pros to the infinite banking concept and using these types of assets of a whole life insurance policy for cash storage and management. Now, always want to be balanced on things because there's, like I stated at the beginning of this podcast, there is no perfect asset in this world, no perfect investment, none that I'm aware of. So they all have their pros and cons to them. Now, the con side to this is that there can be some higher upfront costs associated to get this going because because it is a life insurance policy, there are costs associated with the insurance that have to be paid along the way as you're building up this asset. Because if you're using it more for the banking function, for everyone who's starting this, even if you include a lot of cash infusion up front, it's going to be behind. So in the simple case, if you put $1 in, there might be 60 to 80 cents that you can access through a loan provision early on, and it builds up over time, and it may take 5, 7 years before all the money you've contributed to this account is there for you to use. So obviously, compared to something as basic as a bank account, you're behind. So you just have to understand the long-term nature of this asset and how it can be used along the way as you're contributing to it. So early on, money is hung up, and then you can go access it along the way as the policy becomes more efficient over time. But you have to recognize that there are some upfront costs associated with this type of strategy and approach, and be prepared for it. And that's why one of the big tenets of the infinite banking concept is to think long term. If we're thinking long term, then we can deal with the upfront costs and being a little behind with the thought that we're going to be miles ahead down the road. The second con to this is not like you can just buy it, right? If you buy a mutual fund, you can just buy any mutual fund. There's no really exclusions to doing so. But within whole life insurance and the infinite banking concept, you have to be healthy and qualify for it. The life insurance company does not have to give you these types of policies, and you have to be of good health. Obviously, it will reduce the death benefit costs, the life insurance costs. So it's really important to do this when you're younger, right? And in good health, right? We have no guarantees of what that will look like tomorrow or next week, even. So I always encourage people, even if they're not ready for this yet, at least getting some death benefit covers to protect themselves and their human life value. And then when time permits around cash, you can actually start these sorts of policies and get them going. Because like we said in the first con to this, it takes a little bit of momentum to get it going. So you just have to recognize that going in. And so needing to qualify for this, and depending on the amount you're getting, you may have to go through exams, blood work. So there's definitely more effort to get it going. But, again, this is why the bigger picture matters here. It's just a small cost to pay up front from my perspective, but you just need to know that going in. Now, the third con to this, I think it can get complicated. And, for me, even myself, sometimes I can overcomplicate something more unnecessarily. So from a basic, when you compare this sort of philosophy and strategy compared to getting a simple term policy, it's more complicated, right? There's a number of moving parts, and even the design of these types of policies are different than what you would see in a typical whole life policy, where there's just one cost and it stays flat, and for a certain period of time, it's just simple, right? It's not as many moving parts here because there's an added complexity of increasing the death benefit in the design of these policies so you can put more money in. It adds a little more complexity. So it takes a little bit more understanding of what these are. But that's why you go with a qualified person, especially from the infinite banking concept practitioner world, right? Nelson Nash Institute, where everyone's trained on these things, so you understand how they're designed and they can explain these things to you easily. So, but they can get complicated, and there's a lot of moving parts to it and things that are not always visible to the naked eye in these contracts. So, really important to get with somebody who knows these things, design them for a while, and can explain them in simple terms to remove some of the confusion or complexity associated with them. Now, the fourth con is something that you would hear from most people, that whole life insurance is the worst place to put money and has the worst investment returns. Now, you're going to compare that. Even this is where it's important to realize what this is. And most people can compare it to, say, the stock market or real estate. Well, those are investments that come with risk, no certainty, no guarantees associated with them. So because of the nature of these types of products and how they're designed, they're more equivalent to, say, a savings account or safe dollars, right? It's a storage bin, because within similar in nature, these sorts of the products are free from loss, right? The markets can go crazy, interest rates could change, but there's a guaranteed component of it to grow every year by contract. So this is much more equivalent to a savings account. So when you compare them, they are definitely better, and in a tax advantaged environment can really produce decent rates of return in comparison for what it is, right? Because we're thinking of this as a more of a cash management tool, this is not investment because the risks to these sorts of policies are minimal, right? Obviously, there's always a chance a life insurance company could go out of business, but there are state sort of protections in place that they would essentially buy up a lot of these companies and assets for any failed life insurance companies, and so there are protections above and beyond the individual life insurance company. So the last con I would say to this is there is certainly a possibility that the policies could lapse if they're not managed properly. That does require a little bit more discipline to stay on top of these, especially if you're using these types of policies over your lifetime to finance things in your life, like big car purchases, or what I personally prefer are investments, cash flowing assets, right? Using the policy loans to go invest while our dollars continue to compound. So it does require a little bit more discipline and oversight to manage these things because you're borrowing against your policy, and as a good steward of our dollars, we have to pay that back over time. And so that requires discipline. It requires oversight and ensuring that the policies don't get overextended, so much debt, and then it's liable to be lost. And then, that could result in a lot of damage down the road and even taxes, right? If not managed properly. So it does require a little bit more effort and management and discipline. And so that's why it's not a good fit for everyone, right? For folks who are on top of their personal finances and are disciplined to stay on top of it and pay back loans and manage their accounts, then it's a good fit. But it is, in my mind, for some folks, this is a con because it's going to require a little bit more effort and management and oversight. And for some people, that's not what they want, especially out of these types of assets. So those are the five cons that I would say really pop out to me as something that would be a red flag too if you're ever considering this for yourselves, like understanding what it entails, know what you're getting into, and see if it's a good fit for you or not. And for some, for the extra benefit of these types of policies, it may not be a good fit. So it's really important that you analyze this for yourself and like I said, get with a trained person that will help you explain these things so then you can decide whether it's right for you or not. So hopefully it's helpful, hopefully give you an idea and that whether this is a good fit for you or not, and you know what you're getting into, and certainly reach out if you ever want to discuss it further to see if it might be a good fit for you. Thanks again for joining me, and we'll see you on the next episode.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.